Hello, welcome to this fifth session on finance for non-finance. Next four sessions are very crucial. In these four sessions, I shall discuss about how to convert financial transactions into accounting entries by adopting double entry system. So I would request you is that next four sessions comprising of 30 to 40 minutes are very crucial, and please pay adequate attention to grasp the entire concept of converting financial transaction into accounting entries. I promise you, after these four sessions, you will not find any difficulty in understanding and also to create double entries from any kind of financial transactions in future. Let us start. So in this case, what we shall discuss that how any financial transaction is converted into accounting entries. As we have discussed that financial transactions are implications of inflow of fund and outflow of fund. We have also discussed that if the financial transaction is involving an inflow of fund, what does it mean? Now, it means that the first entry of a double entry system would be the debit entry, and the second entry would be the credit entry. Similarly, we have discussed that if the financial transaction is an implication of outflow of fund, first entry would be the credit entry and second entry would be the debit entry. By applying this very simple principle, we will see that every financial transaction can be converted into accounting entry. As we have mentioned, there are two entries. What are these two entries signify? The first entry would capture the implication of the fund flow. Implication means, as we have discussed, every financial transactions has an implication of inflow or outflow of fund. Apart from that, every financial transaction has timing. By timing, what we mean is that the financial transactions may result in immediate cash inflow or deferred cash inflow, or immediate cash outflow or deferred cash outflow. And third component of the first entry is the way the financial transaction results in inflow or outflow of fund. Whether the fund inflow is happening in the form of a cash or in the form of a check, or fund outflow is happening in the form of a cash or in the form of a check. So in the double entry system, the first entry would capture the implication, the timing, and the mode of such inflow and outflow. The second entry would capture the reason. As we have mentioned, every financial transactions can be categorized either in the P&L or in the balance sheet. So the second entry would capture the reason for such inflow and outflow. Let us discuss this principle in several examples. When you will go through the several examples, then it will be very clear to each one of you to understand the process of converting financial transaction into accounting entries. Let us take how to create a double entry system. Let us take an example of a financial transactions, and then from this financial transaction, I shall create two accounting entries, first entry and second entry. As on June 1st, 2020, a business entity is selling rupees 20 lakhs worth of goods and it receives the payment in cash. Now, what is the first entry? First entry would capture the implication, inflow or outflow. Here it is an inflow. Second, timing. What is the timing? Immediate or deferred? Here it is immediate. Third, it is a mode, whether it is receiving the amount in cash or in check. Now, as we have seen by applying common sense, that this is a financial transaction where the implication is an inflow, timing is immediate, and the mode in which we are receiving the financial transaction is cash. So now we are in a position to convert this financial transaction into accounting entry. Second entry would capture the reason due to P&L or balance sheet for such inflow or outflow. As we have seen in previous session, this is an example of a permanent inflow. Since it's a permanent inflow, it will be captured under the head profit and loss. So the process we will follow for converting a financial transaction into accounting entries by application of double entry system would be as follows. First step, determine the implication of financial transactions. By applying common sense, I find out it's an inflow. Correct? Step 2, timing of inflow, whether it is immediate or whether it is deferred. It's an immediate. Third, mode of immediate inflow, whether it's a cash or whether it's a check. As we can see, it is on account of cash. So the first entry would be debit. Why debit? Because it's an inflow. When there's an inflow, immediate in the form of a cash, the first entry will always be debit, balance sheet, asset, current assets, cash. Always remember, whenever an inflow is happening, immediate cash, then the first entry would be the debit, balance sheet, asset, current assets, cash, rupees 20 lakhs. What would be the second entry? The second entry, as we know, the second entry would be what? The second entry, as we know, would be the credit entry. The credit entry would be profit and loss, income, sales, rupees 20 lakhs. Why it is profit and loss? Because it's a permanent inflow and it is on account of sales. Is it clear? So it's very easy to convert a financial transaction into accounting entry. So just now I have shown you how to convert a financial transaction into accounting entry by adopting a double entry system. Let us take another example. As on June 1st, 2020, a business entity is selling rupees 20 lakhs worth of goods and it receives the payment in check. Everything remaining same. Only thing has changed is that instead of cash, it is getting in check. So the first entry is an inflow, that is, it's an inflow, immediate. Mode of immediate inflow in the form of a check. If mode of inflow in the form of a check, then the first entry would be debit, balance sheet, asset, current assets, bank. In the previous case, it was debit, balance sheet, asset, current assets, cash. Here it is debit, balance sheet, asset, current assets, bank, rupees 20 lakhs. Second entry would be credit, profit and loss, income, sales, rupees 20 lakhs. So that's it. So that means we have learned how to convert a financial transactions involving an inflow in the form of a check, immediate, to convert it into accounting entries by adopting double entry system. Let us take another example. In this example, as on June 1st, 2020, a business entity is selling 20 lakhs worth of goods on credit and it receives the payment after 30 days. So here it is an inflow, but not immediate, but deferred inflow. So we'll apply the same concept. So implication, inflow, timing deferred. So if I look at it, so timing would be the deferred. Now, if it's a deferred inflow, then the first entry would be the debit balance sheet asset, current assets, receivable, rupees 20 lakhs. Second entry, credit profit and loss, income, sales. So when there is a deferred inflow, the first entry would be debit. This debit is because of inflow. So the accounting head would be balance sheet, asset, current assets, receivable. So what we have learned is that any inflow, if it is immediate, it can happen because of cash or because of check, or it can be deferred. In these three cases, the first entry will always be debit, balance sheet, asset. If it is immediate cash, then current assets, cash. If it is immediate but check, current assets, bank. And if it is deferred, then balance sheet, asset, current assets, receivable. Second entry remaining same or identical for these three different types, because the reason for the inflow is same for the three different entries. So I think I have made it very simple to understand how to convert a financial transaction resulting in a permanent inflow into accounting entry by adopting double entry system. Now, let us take another transaction. Which is this transaction? This transaction involves an outflow of fund. Same concept. As on June 1st, 2020, a business entity is paying rupees 2 lakhs worth of salaries, and it has paid the salary in cash. So determine the implication of financial transaction, outflow. Then, is it immediate or deferred? Definitely it is immediate. Next, is it cash or check? Cash. So if it is cash, the first entry will be credit balance sheet, asset, current assets, cash. Second entry would be the debit profit and loss, expenses, salary. Very simple concept. If it's an outflow, first entry would be credit, and the head would be balance sheet, asset, current assets, cash. Similarly, the second entry would be the reason for such outflow. Is it a permanent or temporary? If it is permanent, it will come under the head profit and loss. So debit, profit and loss, expenses, salary. Now let us do another transactions. As on June 1st, 2020, a business entity is paying rupees 2 lakhs worth of salaries, and the payment has been made in check. So instead of cash, it is check. So the accounting entries would be credit balance sheet, asset, current assets, bank, and the second entry would be credit profit and loss, expenses, salary. Absolutely clear in understanding, because why? Same logic. If it is outflow, then credit. Now there can be an outflow which is deferred. For example, as on June 1st, 2020, a business entity is incurring salary expenses of rupees 2 lakhs, and it should make the payment after 7 days. So as on June 1st, 2020, it is not immediate, it is deferred. If it is deferred, then the first entry would be credit balance sheet, liability, current liability, creditor, rupees 2 lakhs, credit profit and loss, expenses, salary. It would not be credit, it would be debit. So let us do that. Let me make a small bit of corrections. Okay. So in these cases, what will happen? All these cases, it would be debit entry. So it would be the debit entry. This would be the debit entry. And in this case also, it would be the debit profit and loss, the current asset, debit profit and loss, expenses, salary. So what we have discussed here is that when there's an outflow, how we are calculating the outflow. Let us look at it. We'll go back to the deferred one again, and then we explain. The deferred one, what we explain. Now this is, if you look at it, this is credit balance sheet, liability, current liability, creditor, and debit profit and loss, expenses, salary of 2 lakhs. So what are the important points we have learned in this lesson? A financial transaction, if it involves inflow and immediate, then the first and cash, then the first entry will be debit balance sheet, asset, cash, current assets, cash. Second entry can be P&L income, P&L expenses, balance sheet assets or balance sheet liability, depending on the reason. Similarly, if it is immediate in the form of a check, first entry would be the debit, balance sheet, asset, current assets, bank. Second entry would be the credit, P&L income, P&L expenses, balance sheet assets, balance sheet liability. In the case of the deferred, balance sheet, asset, current assets, receivable, the second entry would be the same like the previous two entries. If a financial transaction involves an outflow, then if it is cash, first entry would be credit, balance sheet, asset, current assets, cash. Second entry would be the same like debit, P&L income, P&L expenses or balance sheet assets, balance sheet liability, depending on the reason of the outflow. And if it is bank, the same concept. And if it is deferred, then what will happen? Credit, balance sheet, liability, current liability, creditor. And second entry would be debit, P&L income, P&L expenses or balance sheet assets, balance sheet liability. So please pay attention and spend some time on these slides as well as the previous two examples. Now this is very simple. So that means you have learned a very important concept of how to convert financial transaction into accounting entries by adopting double entry system. In subsequent lessons, we shall do a lot of other examples so that you become familiar with almost all financial transactions a business entity incurs or undertakes during the normal course of operation. Thank you very much for watching this video.